Hello, my people. It is good to see you again. This is your village boy reaching out to you from the Village Boy Academy. Yeah, like I said in my last video, I am going to be talking today about overtrading and undertrading and how it can impact on your business. Of course, overtrading is when you are trading beyond your capacity. One of the major challenges in overtrading is, in simple terms, is when you have inadequate working capital. And what is working capital? Working capital is the difference between your current asset and your current liabilities. For instance, if you are taking up some jobs or contracts that take like about 60 days to pay back, to get your money, the process is about 60 days after supply, and you now got some supply on credit, which you have to pay back in like 30 days, which means you are supposed to pay your suppliers, your creditors, before your debtors pay you. And if this continue for a long time, you see you have a case of whereby you have a huge amount of creditors and a very minimal amount of debtors. So in that case, you also know the danger in that is that your creditors have a legal right over you to ask for creditors wind up, so they could actually wind up your business. For instance, if you are owing let's say you are owing hundred $10,000. I mean, let's use dollar for this as currency of international trade, so to say. And but your debtors is just about $5,000. Those who are owing you 5,000, but you have $10,000 to pay. Those who have taken your goods from, you might be, having a case of overtrading in your hands. Of course, one aspect of it is like you are taking up a job and we also have a low margin, so you are thinly spread. And when this money is also tied down, in debt, you're having a debtor or debtors that may or may not pay. So you might, be overtrading. But in the more technical terms, overtrading is when you are undercapitalized. It's usually a case of undercapitalization, where mean your capital is lower than your business exposure, and that could pose a lot of danger for you because over time you discover that you will fail to deliver to your customers, and as when you don't deliver to your customers and when you take on more jobs and your capacity can hold, you may be heading heading down south, by meaning that your business may be going down south, your business may be may eventually collapse. So of course, on the other side of the spectrum is other trading, where in technical terms you are overcapitalized. Let me use the example of what happened in Nigeria in the 90s, where the IPO, initial public offer, became very popular. So many banks shares were oversubscribed, so they had more money than they actually bargained for. So because of that, they find themselves in a situation of under trading, and many of the banks then collapsed. Some had to merge to become, especially when Soludo came and they did the capitalization of banking sector. That was able to save some who were able to merge, but even then, others went under. So if you have excessive capitalization, maybe you have excessive um, working capital, it means that you may be under trading, in which case you are taking jobs which is far below your capacity. And the one of the consequences of that is that your cost may be rising where your income is reducing, because when you are not generating enough income to cover especially the fixed cost, for every business there is a fixed element. That fixed element of your business, which means whether irrespective of what you have sold or you are selling, these are costs you must incur. For instance, you pay your rent if you are not the one owning the house, I mean the building where you locate your office. These are fixed costs. So whether you are selling 10,000 a month or 1 million in a month, it doesn't matter. What matters is that you have to pay the rent. So when your fixed cost now cannot be recouped from your income, you might well be, under trading. For instance, you have a big factory, and that factory is underutilized. Maybe you are utilizing like 20 to 30 percent capacity of your factory. Then you must well be under trading. And of course, the like I said, the danger there is that your cost will pile up and your revenue will be shrinking, and that is an express road to bankruptcy. So either under trading or over trading, none of them is good. So you have to have a balance, between your business, and one of those things balance is to have adequate working capital. Working capital that is enough for you to run your business. For instance, when you are owing, you are obliged to pay. But when somebody is owing you, well, you are at the mercy. The person may or may not pay. For instance, the business is owing you and the business has collapsed, or the business has filed for bankruptcy. So that business may not be in position to pay you. And when they don't pay you, there's something you can do about it, and you have case of doubtful or bad debts which you may have to write up. I think in some subsequent editions, I will explain the concept of doubtful and bad debts. So when your debts are piling up and you are unable to pay your creditors, you are now at the mercy of your creditors, which they can apply for creditors wind up. And when your business wind up, you are gone. So overtrading is risky. It makes you to be at the mercy of your creditors. Undertrading is also risky because you are piling up costs which you cannot recoup from the income generated by the business. So you must be able to strike a balance in your business to ensure that to avoid the incidences of either overtrading or undertrading. So by having a robust working capital, some businesses are profitable, but because they don't have adequate working capital, it gets to a point that they can no longer take up new businesses, they can no longer take on new contracts. And of course, that means that also the revenue is shrinking. And of course, again, they will still be faced with the issue of fixed cost. Fixed cost is that those costs you must incur, irrespective of your level of activity. And those are the things that you see businesses that is one thriving in the neighborhood. You just suddenly hear that business is under receivership because they cannot pay their creditors. So remember what happened to the almighty IT in Nigeria and what happened to Silverbird. This is a case of probably overtrading. They are doing more than they are biting more than they can chew. And when this occur, the creditors come calling, and sometimes they don't show mercy. They just the sledgehammer, to get you out of business. It's not sentimental, it's not bad. It's just what it is. So you have to constantly monitor your working capital to ensure that you are not having idle fund or idle capacity in some area which is under trading, and you are not having overstretched capacity, which is a case of overtrading. When you have overstretched capacity, I mean you are stretching your company, your business beyond your capacity. For instance, if you can produce 20,000 items in a day, and you are taking on a business that is almost like 50,000 items per day, you will soon run into trouble. So either way, you have to know how to manage this process to have a balance. One of the issues to have adequate working capital. Adequate working capital is like it is not idle. Your money is not idle. Then that is your money. You are left at the mercy of your creditors when you don't have money to pay them. So you have to always learn to strike that balance. It's not difficult, and of course, all this information you get when you have adequate accounting record. Like I said the other time, accounting is the language of business. Ensure that you understand and you speak the language of your business. I am your village boy. So until I come again to you next time from the Village Boy Academy, make sure that your working capital is adequate, is sufficient, and your business is not overstretched, and you are not underutilizing the capacity you have built over time. Make sure you watch, share, and subscribe. Thank you, and God bless.